let's cover some terms and jargon that are thrown around in the investing world that are important to understand. I know how difficult it can be when you're trying to learn about investing, but every other word is either jargon or it's just a word that you're unfamiliar with. And even now, I'm trying to broaden my understanding about the world of investing, and there's still words that I'm unfamiliar with. So I'm going to try and break some of the most common ones down today. I'll really be trying to break these down and define these words as simply as possible. So it's a one-stop shop where you can understand what these words mean just by listening to this video. And of course, there are lots of words out there, so I won't get through them all today. But if there are any more that you can think of that you need defining, leave them in the comments below and I'll definitely do another video in the future. The first term is dollar cost averaging. Dollar cost averaging is actually relatively simple to understand, and all it means is regularly setting aside a certain amount of money to put into purchasing a stock regardless of the price per share at that given time. The reason for doing this is because it spreads your risk. So you're not trying to time the market. You're not trying to just buy a stock when it's at a low price. You're just purchasing it whenever, and over time, this will average out the price that you're buying it for. And this really helps to reduce and spread your risk. This can also be transferred to pound cost averaging or whatever currency you use. For example, if I was to follow a dollar cost averaging strategy, then I may decide to put $1,000 into purchasing a particular mutual fund every single month on a particular date. Now, this means that I'm not using my emotions to determine when I'm investing. I'm not trying to time the market, and I'm completely removing my emotions, which is always a good thing in investing. By doing this, you are averaging out the cost that you're spending on purchasing stocks and shares. So if you are purchasing them on every single Monday of every single month, you are not buying them when they're really high or really low. You're going to get an average over time. The next words that I've bundled together are stocks and shares. Now, quite often these two words are used interchangeably, and I'm going to keep this really simple so that any beginners watching this can start building their confidence. A stock is an ownership in a company. So for example, I own a stock, or I own stocks in Microsoft, whereas a share specifies exactly how much you own. So for example, I own 6 shares in Microsoft. So the main difference between stocks and shares is that a stock is a broad concept that represents ownership in a company, whilst shares are the individual units of ownership. The next word on our list is dividends. Dividend is an amount of money paid out by a company using its profits to its investors, so anyone that's decided to invest in that company. Now, if you think about it, it's kind of like the company saying, hey, thanks for investing in us. We've been performing really well, so here, have a little cash reward. Now, these dividends could be paid out monthly, they could be paid out quarterly or even annually. It really depends. And it's important to say that not every single thing you invest in will pay dividends. It really depends. Next, we have mutual funds. Mutual funds are a collection of individual stocks all bundled into one package. This means you are buying one thing, but actually you're investing in many different things. And this is really good for diversification, and we'll define what that means in a minute. Mutual funds are actively managed, and this means that they are managed by a professional, and this can be a good thing. It means that they are the ones picking the stocks for you. However, this does come at a cost. The next term is index funds. Index funds are a type of mutual fund that track a particular part of the stock market known as a market index. They provide investors with a broad diversification, but for a much lower cost than mutual funds, and this is because they don't use an investing portfolio manager. Next is S&P 500. S&P 500 stands for Standard & Poor's 500 Index, which tracks the 500 biggest public traded companies in the US. So, for example, if you were to invest in the S&P 500 index, you would be investing in 500 of them top companies in the US. This would include the likes of Apple, Microsoft, and Facebook. Next, we have ETFs. ETF stands for Exchange Traded Funds. And these are very similar to index funds and mutual funds, except they are a little bit different in the fact that they are traded constantly throughout the day. So this means that the price can really fluctuate at any given moment. Whereas with index funds and mutual funds, these are only bought or sold when the market closes at the end of the day. The next term is the stock market. The stock market is a place where shares of publicly traded companies are traded. So it's basically a place that you can go as an investor to buy and sell your stocks, shares of these companies. The next term is a very important one for investing, and that is compounding or compound interest. When you reinvest your earnings, they can earn more money. The process of continually reinvesting your earnings is called compounding. And compounding investments can grow a lot faster than if you continuously just withdraw any earnings you make. Now, I have made a video all about the importance of compound interest before, so if you want to know a little bit more about this and have some examples given to you, then check out the video that I'll link here. The next one we have is diversification. Diversification is seen as a really good thing in investing, and what it means is having a diverse range of things in your investment portfolio. So this would mean that you would invest in different companies of different types all over the world. So you wouldn't just be investing purely in UK stocks. You would have, companies from the UK, companies from America, companies from all around the globe, as then you're spreading your risk. And this also means that if you've only invested in the UK and the UK economy then plummets, you're going to lose lots of your money. Whereas if you've invested globally, it's very unlikely that the whole global economy will go down. So as I said, you are reducing your risk. The next term is bear and bull markets. When stock prices drop, some investors may refer to this as a bear market. And when the stock prices rise, they refer to it as a bull market. A bear market could be an opportunity to buy more stocks at cheaper prices. However, in my opinion, timing the market is not a very stable strategy and not one that you need if you're planning for long-term investments. And the final term on our list is price to earning ratio. The price to earning ratio is often abbreviated to PE, and it's the ratio of the share price against the company's earnings. This can also be called the earnings per share or the profits per share. The smaller the PE ratio, the higher chance you have of more earnings. So that was my list of some really common investing jargons and terms that any beginners out there should be aware of, and I really hope that that was helpful. If you found it helpful and you've liked this video, please give it a like and subscribe to the channel. And as I said earlier, if there's any more words or jargon that you want defining, leave it in the comments below and I'll look to do another video similar to this one. Check me out over on Instagram at Haleys_hacks, where I post a lot more behind the scenes type content. I'll also write a blog on this list, so if you're interested in that, I'll leave that in the description. Really appreciate you watching this video. Thank you so much. Subscribe to the channel if you haven't already, and I'll see you in the next video.